According to Deloitte, most retail executives anticipate inflation will squeeze profits and lead to decreased consumption in 2023 due to rising financial concerns. Target's current performance is concerning, with recent data showing a downward trend. Even top executives admit to the severe challenges facing the chain, which are harming their financial well-being. In the past year, the retailers experienced an unprecedented 90% drop in profits. However, its strategy to counter their losses by raising prices in 2023 has seemingly compounded its problems instead of offering relief. So, in this video, we'll discuss Target's major challenges, which can bring the company's demise closer than you think. But before moving on, consider subscribing to the channel and hitting the notification bell so you don't miss any future uploads. Changing taste. Consumers are exhibiting a lack of interest in purchasing 60% of the company's inventory. The remaining 40% carries significantly higher price tags. This paradigm shift is steering shoppers away from other retail alternatives, leading to a cascade of disappointing sales for Target. As of May, Target sales at stores open for at least 1 year increased by 0.7%, and the company said customers were spending more on food and essentials. However, profit fell 5.8% in the quarter. The company reported a decrease in sales of clothing and home goods. On the other hand, sales of food and beverages have seen an increase. According to Target's chief growth officer, the decrease in sales of discretionary items is attributed to the persistent inflation in groceries and essentials. This information highlights the impact of inflation on consumer behavior and spending habits, which is a critical factor that businesses like Target must take into account. Boycott. Target's popularity has hit a new low due to backlash over its Pride range. According to newly released figures by pollster YouGov, the brand is still in the top 5 most popular department stores in the US, but has slipped down the rankings, now sitting below Costco and Dollar Tree. In the second quarter of 2021, Target's popularity was 65% among 1,560 respondents nationwide, its lowest since tracking began in the third quarter of 2020. Previously, Target enjoyed highs of 71%. Currently, 15% of respondents dislike the brand and 19% are neutral. As a result, Target's stock has fallen by $13.8 billion in the last 2 weeks of May, reaching its lowest point in almost 3 years. The retailer, which is known for its affordable and stylish products, has been facing criticism for selling LGBTQ-friendly clothing for kids. The company's stock dropped 2.2% to $130.93, marking the longest losing streak since November 2018. This has brought the company's market capitalization down to $60.4 billion, a 19% decrease from the $160.96 on May 18, 2021, just before the crisis. The worst economic condition in 2 decades. The story takes place within a context where Target has been facing a prolonged period of financial instability for more than 20 years. Even before the early 2000s, marked by economic market upheavals, Target did not experience the same level of significant losses that it encountered during the years 2022 and 2023. The preceding year bore witness to losses in all 4 quarters, with profits plummeting by 49% in quarter 1, 90% in quarter 2, 54% in quarter 3, and 52% in quarter 4. Despite the company's offering substantial discounts to clear surplus inventory, sales across both their brick-and-mortar stores and online platforms remained lackluster. This year, the landscape has become even more challenging as consumers reel in discretionary spending in response to a faltering economy. The crux of the issue lies in Target's heavy focus on general merchandise categories such as apparel, accessories, and home goods. Historically seen as their forte, accounting for over 60% of their inventory. This translates to a staggering 60% loss in potential sales. Severity of this predicament is echoed by industry experts, including former Walmart CEO Bill Simon, who points to the ominous cloud of recessionary trends looming over retailers like Target. When Americans think of Target, they often picture a cart filled with trendy home decor, cosmetics, or stylish clothing. However, the retailer hopes to expand its customer base to include those who think of it as a go-to destination for grocery shopping. Target's financial filings reveal that only 21% of its annual sales are attributed to food and beverage sales. This is a notable contrast to its competitor Walmart, which generates almost 60% of its yearly sales from grocery aisles. Target's inventory. The dichotomy between Target's product inventory and the changing consumer priorities is where the core problem resides. Consumer preferences have veered towards groceries, household essentials, and non-discretionary items, a departure from Target's focus on general merchandise. While approximately 39% of their products reside in the grocery category, this hasn't translated into a substantial increase in grocery sales for Target in 2023. The data from the first quarter tell us a bleak story with a meager 0.9% increase in overall grocery sales. One contributing factor is Target's decision to introduce price hikes, particularly within the grocery category. However, this strategy has met vehement resistance from customers. Over the span of a year, Target's grocery prices have surged by a staggering 21%, stark contrast to Walmart's 27% increase over a span of 2.5 years. These changes in pricing have exacerbated customer concerns about affordability and value. Moreover, reports of empty shelves and inconsistent product availability within the grocery section further eroded customer satisfaction. The decision to raise food prices has occurred in the midst of other retailers working assiduously to manage inflation and attract customers, putting Target at a significant disadvantage. And problems with products will only exacerbate the company's profits. For instance, Target recalls 2.2 million candles following reports that the glass jars containing them are breaking or cracking during use, resulting in one minor injury. Price hikes. Target's choice to implement price hikes at a time when consumers are already grappling with affordability issues has backfired. Customers have voiced frustration at the notable escalation in prices for everyday goods. For instance, watermelon prices have surged from $3.99 during promotional periods to as high as $9.99. These changes have fundamentally altered customer perception of the value proposition offered by Target. The backlash to these changes is not limited to mere discontent. It's led to a discernible shift in shopping behavior, with customers demonstrating a reluctance to purchase at elevated prices. The adverse impacts of this strategy are further exacerbated by the availability of discounted discretionary items, rendering the price hikes less palpable. This decision came at a time when competing retailers were diligently working to control inflation and attract customers, placing Target in a precarious situation. Inflation. As inflation rates persist, customers are increasingly drawn to promotions and discounts while displaying hesitation toward making purchases at the total price. CEO Brian Cornell acknowledges the impact of inflation on their customers and with their shopping habits undergoing a discernible shift. The sustained presence of inflation and its implications on consumer behavior presents a challenging landscape for retailers, further compounded by the ongoing macroeconomic uncertainty. Target is the latest retailer to say shoppers pulled back on items like clothing and home goods and shifted to groceries and necessities. Lower and middle income consumers have been squeezed the most by rising prices. Retail theft The issue of organized retail crime has worsened Target's financial struggles with an estimated loss of $500 million in stolen and lost merchandise in 2023. Current situation for Target is concerning, as inventory shrinkage has been on the rise and has increased significantly compared to the previous year. Target said it expects to suffer as much as $1.3 billion US. However, that's not only one side of the medal. Major retailers have reported disappointing earnings due to organized gangs stealing from their stores, and this issue may arise again during second quarter reporting. According to CNBC, some retailers, including Target, blame shrink on the theft, but it's difficult to determine the exact cause. Retail analyst Neil Saunders suggests that internal issues and stumbles could also be contributing factors. Stock outlook. These financial challenges, combined with market dynamics and consumer pressures, have led industry analysts to speculate that Target's decline may occur earlier than anticipated. In the midst of this turmoil, Target's stock values have experienced a notable decrease, resulting in uncertainty about the company's prospects. JP Morgan downgraded Target due to the concerns about the retailer's ability to maintain its strong market position. The investment bank cited increasing competition from e-commerce giants and changing consumer preferences as potential challenges for the company. Additionally, JP Morgan expressed doubts that Target's ability to adapt to the evolving retail landscape, suggesting that the company's digital transformation efforts might not be sufficient for a long-term success. Target's performance serves as a reminder that even established brands are not immune to retail's evolution. Its challenges stem from errors in pricing strategy, non-essential merchandise, and an inability to adapt to changing consumer preferences. Thank you for watching. Hit the like button if you enjoyed the video, and as always, share your opinion on the subject in the comments section below.